Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Hi all, welcome to another episode. This week we're going to speak about unlocking profit and using advanced strategies for commercial property investors. When I say advanced strategies, it's strategies that are very simple to use, but it's what investors used when they're more advanced in their line. But you'll see it's very easy to use. So the parts that we're going to speak about today is, firstly, we're going to speak about commercial property valuation techniques, which is important when acquiring a property to make sure that you don't overpay for it. And the second part, we're going to describe how to plan your exit. So we're going to explore strategies for leaving the market. Two ways to, obviously, that are very important in commercial real estate is the price you pay for it and the price you sell for it. So you want to maximize on the exit and obviously make sure that you purchase at a good price when you enter into it. So these two are very important. Then lastly, in the third part, we're going to speak about the middle stage, so to speak, of the investment, and that is delegating the day-to-day. So the role of the property management. And all three of these, if you do it correctly, will lead to a successful investment in the asset. So let's get straight to it. So property valuation techniques. The first one and the most commonly used one is what we call the income capitalization approach. So what this does is it estimates a property's value based on the income it generates. Commercial property is all about income. The more income it generates, the more value the asset has. The capitalization rate, or the cap rate, so to speak, is the going rate that the market is willing to pay for it. And this has all got to do with the yield. So if the going rate in the market is a 6% yield, then the actual income, the net operating income, is capitalized by this rate. So what does this mean? So let's take an example. If a property generates $100,000 in annual net operating income and has a cap rate of, say, 8%, its estimated value will be $1.25 million. How did I get that? I took the income of $100,000 and I divided it by the cap rate of 8%. So let's take another example. So let's say you're considering a retail space with an NOI, that's net operating income, of $150,000 per annum. So based on your market research, the typical cap rate for similar properties in the area is 7%. Using the income capitalization approach, the estimated value of the property would be the $150,000 divided by the 7%, reaching $2,142,857. But this makes sense, right? So if your yield is your annual income divided by your purchase price, then if you work it backwards to get your purchase price, it's simply the annual income divided by the cap rate or the yield. So that's how it works. And this is the most commonly used valuation technique in property. And this is commercial property, that is. Then the next approach, which is more commonly used in retail property investments, is the sales comparison approach. So the difference here is that this method compares the subject property to recently sold similar properties in the area. So this takes into account the factors like size, location, and property type are considered when making those comparisons. So let's use an example. Imagine you're valuing an office building. You would research recent sales of office buildings in the same neighborhood, and then with comparable square meterage and amenities. The average sale price of these comparable properties would provide a benchmark for estimating the value of your subject property. So, for example, if you're looking for an office space, you would consider the size of the office space in square meterage. You would consider the amenities around it, and then you would compare it to a similar size office space in the area and which has access to similar amenities. If that office space went for a price of, say, $1 million, then you know that the asset is worth $1 million. But I take it a step further. I consider what the cost per square meter is in terms of the price. So if the asset was $1 million and it had a square meterage of, say, 250 square meters, then the actual price per square meter is $4,000. So I would compare a similar asset of a $4,000 purchase price, and I would take the square meterage of the asset I was looking to value and multiply it by that square meterage cost. And then that's where you would arrive at the actual purchase price. Then lastly, the third approach we take in valuing property is called the cost approach. Now, the difference here is that it estimates the value of a property by considering the cost to replace it. So that takes into account the things like the cost of land, construction materials, and depreciation are factored in as well. So this method is often used for new properties or those with limited rental history. Bear in mind that you might find that in hot markets, property might be valued at more than the valuation cost. And in finding opportunities, if you find an asset that is valued less than the replacement cost, then it might be a great property to buy. But obviously do other research as well to make sure there is not something that is making the property value underneath the replacement cost. Moving on to the second part, and this is planning your exit. So exploring strategies for leaving the market. As I mentioned before, the two most important ways to make a good capital appreciation in your investment realized is to purchase it well, purchase it at a good price, and then to maximize the sale price of your asset. So these are the techniques that we use when we sell the property. The first one is selling the property outright. So this is the most straightforward exit strategy. Here, market conditions and property value appreciation will determine the profitability of this approach. So that's just going to market with your property and selling it by realizing the actual increase in your rentals, and then with an attractive cap rate. So if it's a hot market, you'll find that you'll get a cap rate compression. So if you purchase it for 7% and you're able to sell it for 6%, that 1% cap rate compression will increase the value of your property significantly. The second approach is to complete a development project. So what I mean by this, for some investors, acquiring a property for redevelopment might be the exit strategy. So you determine what your exit strategy is upfront prior to purchasing the actual asset. So this strategy does require significant expertise, construction knowledge, and the ability to manage risk associated with the development projects. If this is done right, and you purchase the right property in the right location, and you're able to develop the actual asset further by adding to it, the approach can be a very profitable and successful one. Then the last approach in planning the exit is to sell to real estate investment trusts, or REITs. REITs often acquire income producing commercial properties, and this can be a great exit option for investors seeking liquidity. REITs have got capital to deploy, and if you are if you are going to sell your asset and you're looking for an easy way to sell it to people who've got a mandate to invest in these properties and they have got liquid capital to use, then approaching a REIT is a good option, depending on whether the asset meets their criteria, of course. Moving on to the last part, and this is delegating the day to days. This is the role of property management. So when you acquire your asset, you want to make sure that you maintain it well, you manage the tenants correctly, and as a result, you make sure that the cash flow in your business or the actual property, so to speak, is solid and is increasing over time so that you can maximize the capital appreciation of your assets. Now, doing this, many investors would choose to hire professional property management firms to handle the day to day operations of their commercial properties. Now, what do these property managers do? They perform various tasks. We've already touched on them, but let's go through them properly. So, the first one is tenant management. So, their job is to find and screen tenants, collect rent, and enforce lease agreements. They are professionals in this area, and it's a very complex area and difficult and time consuming area to manage on your own. So, getting a property management firm that is professional and is experienced in the area can add a lot of value to you in this, not only in time, but in expertise. They also perform property maintenance activities. So they oversee repairs and they ensure the property is maintained in a good condition. This is a very important aspect because you need to make sure that the asset remains in a good condition. This is to keep your tenants and also to keep the capital appreciation in your assets going. Lastly is the financial reporting. Property management firms provide regular financial reports to the investor on income and expenses. This is like having your own accountant working on the actual property, and you'll be using these financial reportings not only for your own tracking of the investment, but when it comes to tax purposes, it makes your life a lot easier. Now, this is a lot of trust that you're placing in the property management company. So it's important to choose the right property management firm. But how do you go about doing this? Well, the first thing to check is to see what their experience and track record is like. So you must look for a firm with experience of managing similar property types in your area. What we do is we call around and we ask the property management firms various questions. And this has got to do with their experience and track record. And you get a feel after speaking to them whether they are on top of their market. So you can ask them questions like, what is the going cost per square meter in the area? What is the going rental per square meter in the area? And see if what they're saying actually ties back to what your due diligence has suggested. And if it doesn't, it might be a red flag. The other thing to consider when choosing a property management firm is their fees and services. So you must clearly understand the fees charged and the services included in the management agreement. Property management fees in Australia can range quite in a broad range that is, and that can be between 4 and 12% of the gross rental income, with the average fee around 7%, but this is including the much smaller assets as well. So keep in mind that if you have a larger portfolio of long-term contracts with a property management firm, then we would expect the range to be in the 4 to 6% range. Then for smaller properties requiring more intensive management services, you might find that the fee will increase to the upper range. And lastly, the last thing we look for in choosing a property management firm is the communication side. So make sure that they have got a clear communication, good working relationship with you going forward in your assets. Well, that's it for today's episode. If you found this valuable and informative, please leave us a like and let us know what you would like us to cover in future episodes. Speak to you on the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.